It's very exciting to stand up here and deliver these results. The several years that we've been working with David and his team on this have been very, very fulfilling. It's been exciting stuff. And as I was sharing with some of my colleagues here at the table, there's so much data here, and there's so much insight we can gather from it, that to try to put it all together in a report, we were constantly writing things down and throwing them out. What I'm going to do here is really hit just a couple of the themes and things that we discovered. I would encourage every one of you to read through the report, particularly the charts in the back, which again, Frank Tsai, the master of statistics, helped put together, and some of the trends that you can see there, and would encourage you to even use it to speak to your management team as well. As Brenda said, this 420 responses here. For those of you geeky enough to enjoy survey research, 25% is a huge response. And so again, thank you for all of you who are doing this. Some demographics at first. Manufacturing, 47%, services, 41%, and retail, 11%. That 47% is down from 61% in 2010. So we are starting to even things out here. We asked, where in Shanghai do you have a presence? Obviously, a majority are in Shanghai, but many have offices and presence elsewhere around China. And how long has your company been in China? 57% of us have been here more than 10 years, and 15% more than 20 years. It's encouraging to say, to when we have this level of experience, the responses that people offer can be that much more meaningful. As Brenda said, one of the themes here is that this is a market in transition here for U.S. companies. First of all, the performance was very strong. But what we're seeing here for the second year in a row is year-on-year performance is starting to flatten out in terms of profitability, revenue, and operating margins. This leveling off really does reflect this ongoing transition in the China market that has been built and sustained on export and investment-led expansion. And now it is moving into one more of consumption and services. The challenges remain, of course, rising costs, human resource constraints, and as we've seen this year, an increasing competition, particularly from Chinese companies, is going to be a huge challenge to companies in the coming year. Still, throughout all of this, and I think one of the reasons we're all sitting here is we do believe there is a tremendous opportunity for U.S. companies within this, as China market is going to be expanding and is going to be changing in its nature to one of increased household income and consumption. Let's get down to some of the data. Overall, we're seeing a year-on-year performance is leveling off, but the investment is still continuing. So first of all, this is the slide, and I'm going to point over here, sorry, on profitability. Again, 73% of companies surveyed are profitable. I'll say that again, 73% of us are profitable. That is a huge indicator of performance. Where we start to see some changes again is when we look at year on year. And this means, is your revenue up from last year, and are your operating margins up? We all remember 2009, not very fondly, I'm sure. That was a pretty bad year. But since then, obviously this is a year-on-year jump, but we're starting to see it flatten off here. We are expecting that this trend to continue, maybe slightly down, maybe about the same, but it's doubtful right now that we're going to see a huge jump. If we look at forecasts here, and this is for forecasts for next year, we asked last year, so it's 2013, of an increase of more than 10%. 55% of us have said we are thinking of increasing more than 10%, our forecast revenues. Investment is also up. This is an increase of 15%, so over a third of us are going to increase investment here in 13%. And this, again, a record here, 91% of us are optimistic about a 5-year outlook. So again, while we're seeing this leveling off, and we don't have these wild levels of growth of 12 and 13% and sectors growing at crazy rates either, we are seeing still very good performance, and all of us, or the majority of us, are very optimistic. We ask questions about the business strategy. Why are you in China? And again, and we've seen this trend over the 12 or 13 years we've been doing this, is that most of us, 60%, are in China for China. In other words, we are here in the market to serve this market. Those of us who are here to produce in China, to export back to the U.S., only 17%. And again, that's been one of the big discussions here in international media, and particularly politics back in the US on some of these trends. 12% of us, the primary reason, a primary business strategy is to import goods into China. Those, of course, are mostly sales companies. But that 60% is one that I think we should all take encouragement from, that we are in China to serve the China market. We asked a question this year of investment. And what is your investment going to be, or I'm sorry, what was your investment in 2012 over 2011? 74% of us increased our investment in 2012 over 2011. 74%. The majority, of course, increased it from 1 to 15%, but there were still a few, 7%, who increased our investment over 7%. Only 1%, and I won't ask you to show your hands, decreased investment in 2012. Another question we asked this year was how does China stack up in terms of investment against other options? Every global company has options. They can invest in China or they can invest somewhere else. What we wanted to understand is how does China stack up against that? The number one priority, those who said the number one priority, 21% of us said our number one priority was China. A top 3 priority was 54%. So this is over 3/4 of us here. Add those together. Over 3/4 of us think that China is a top 3 priority globally here. And only 19% said one of many. What this is showing that China is moving from a nice to have to a need to have. And again, the large attendance at sessions like this are proving that we're all desperate for insight into this market, because I'm sure we're all getting phone calls from our bosses at night asking how China's going. We also asked a question this year about investment in China versus investment in global operations. There have been rumors and people have been talking about, given the slowdown in China, are companies closing operations in China? Are they reinvesting someplace else? And the answer, at least according to this survey, is decidedly no. 48% of companies surveyed said they will make additional investment in global operations will be made inside China. Now, 13% said they're going to be making them other places as well, but that 48% against the 13% is a huge gap. Only 3% of companies surveyed said that they would be shutting down operations outside of China and moving them into China, and only 1% said they'd be shutting down operations in China and moving them elsewhere. So what we see again is the importance of China as a need to have. Investment is still going to be very, very strong here in China. Great news. All very exciting, a lot of percentages, big numbers, big investment. There are challenges. Those of you who have been listening to this for a couple of years, you know that we separate challenges into 2 different types. We look at business challenges, which we think are kind of common to every market, and we look at legal and regulatory challenges, which are common to maturing markets. We asked 2 questions in the survey. Number 1, does this challenge hinder your business? We used to ask the question, is this a problem? And some people would say yes. Well, we need to know, is it a problem for you? And is it getting better, deteriorating, or staying the same? What we're looking for is both a baseline of where it is in terms of hindrance, and we're looking for a trajectory for where it's going. And again, year on year, we've been able to see some interesting things. Overall, again, as last year, business challenges were greater than the regulatory challenges. And the top business challenges are getting worse, they're getting more challenging, and the top legal and regulatory challenges are staying the same. So let's look at the leaders here. There's a lot of stuff here that actually maybe the panel can get into some of these as well, and if you have questions on these as well. Last year, for the first time, rising costs became the number 1 challenge over HR constraints. Previously, HR constraints was the number 1 challenge year on year on year. Last year, for the first time, rising costs became. This year, again, rising costs was the top challenge. And 60% of us say that it's getting worse. HR constraints, finding, training and retaining good people, 89% of us think that is getting in the way. Domestic competition, and we'll see this as a theme, 76% of us said that domestic competition was an issue this year. It's the first time this has shown up here as well. Lack of market maturity always shows up, even though China has made giant strides. There are places, particularly as we move on into Tier 2, Tier 3 cities, where a market maturity is an issue. 5 and 6 are particularly concerning, and they've shown up again this year as they did last year. 69% of us say that fraud and corruption is a challenge, that it hinders our business. And 63% say that IPR gets in the way. One thing to notice here is these are the top 6 challenges, and the lowest number there is 63%. So what that's saying is that 2/3 of us, at least 2/3 of us, face all these challenges in our daily lives here in China. This is some pretty serious numbers. One of the questions that we had last year when we talked about rising costs was what makes up the cost? What contributes to that? And of course, labor costs, as we all kind of suspected, came in at number 1. Now this means that HR constraints and rising costs are certainly tied in together. But labor costs were 89%. Interestingly, taxes within China, 43% said that this was a contribution to their rising costs. And then it goes down from there. Only 1% said that costs are not rising. And if you would please talk to me after this, I would like to validate that. Let's look at some of the regulatory and legal challenges. Remember, when we asked the question, is it getting better, getting worse, or staying the same? We added in here staying the same so you could see that this is one of the big takeaways from here. So, as usual, bureaucracy and unclear regulatory environment came in at 1 and 2. 81% of us struggle with the bureaucracy that we face in China, 75% in an unclear regulatory environment. The interesting thing, and this is again a theme from last year, is that this is not deteriorating too much, 10%, 17%, okay, it's somewhat deteriorating, but a majority of us are saying that it's staying the same. After this long in China, after China has been open for this long, the fact that this is kind of stalled is important. Tax administration came in at number 3. And again, related to the rising taxes contributing to the rising costs, this is probably not a surprise. We wanted to dig a little bit deeper and find out what is the practical impact, what is the commercial impact of this lack of transparency in the regulatory environment. And so we asked a series of questions to say, how do different types of companies, in your mind, how do different types of companies react to this lack of transparency? And what came back is that this lack of transparency, there was a preference for local companies. That this lack of transparency favored the local company, who is either favored outright in a regulation situation, or because they're a local company, knows how to navigate it more. Foreign and local treated equally went down, and preference toward foreign companies went down. You'll see that the drop in this one and this one is exactly the contribution to the increase in preference towards local companies. So we're starting to see a move that way and a concern for local competition. The changes in the regulatory environment. And this was a jump again in those that thought it was deteriorating. 37%, it was pretty normal, 29 year on year, and then in this year it jumped up. Just the opposite happened in the no change. This went down and was replaced by the deteriorating. So the regulatory environment is not very transparent. There's a feeling that the local companies have some preference, and we do think it's starting to get worse. This is a massive challenge sitting in front of all of us. Just generally in challenges across the sector. First of all, human resource constraints, consumer goods and healthcare and automotive were the most seriously hindered by this. Again, in this survey, because we have such a large data set, we're able to run results by sectors and get some really significant results from this, and it can be very helpful. On the corruption and fraud, healthcare was the most seriously hindered there. On the IPR front, there was little improvement overall. It's kind of stalled in terms of how it's going. IT and telecom said they were the most seriously hindered. And on the increased competition side, interestingly enough, companies said local private companies, they were more concerned about competition from them than they were concerned about state-owned enterprises. Again, it would probably depend on the sector, but the fact that the local private companies were so strong is an interesting finding. So at the end, what are some of the key takeaways? Well, first of all, China is a vital and a necessary market for all of us. Over 40% said that China had the highest margins of anywhere in their company. Over 60% said that China revenue growth was the highest of anywhere in their company. And 48% said they will make additional investments in China in 2013. So it is important, and it will continue to be important. The growth drivers are changing. One question we asked is, where is your growth going to be coming from? Is it going to be coming from an acquisition, mergers and acquisition, or is it going to be coming from organic? 76% said organic strategies, rather than M&A, is going to drive growth for them. What this is forcing companies to do is look at their platform, look at their foundation operation, and make sure that it's healthy so that they can grow on it, so they can add people, they can add distribution, they can add capacity. So the continued prevalence of fraud and corruption is going to be a challenge, where our base foundation may be a little bit shaky. Another finding is U.S. companies are continuing to support the U.S. economy. 59% said they export from the U.S. to China, and 44% buy from suppliers who import from the U.S. These are some very significant findings that hopefully on the door knock will help out in talking with Washington, D.C. As I just discussed, the regulatory and legal environment remains a huge challenge. And more than 65% said that the regulatory environment was not improving or was deteriorating. And just in my conversations with my friends and from around the business community here, this is a topic that comes up quite often. Finally, there's a danger to standing up here and saying, this is China. This is what's happening in China. This is what all U.S. companies are doing. We've got good data, but as you know, China is a very big place, and our companies here, there's a lot of variety in our companies. So the performance very much depends on industry sector. The top performers were typically those in the quality of life sectors, healthcare, automotive. Healthcare and automotive were the two that are investing the most aggressively in China as well. And the companies in the retail and services sector scored higher than manufacturers on the confidence index, and we haven't even talked about our indices here as well. Again, I would encourage you to look at the report. Those of you that are on committees, number one, join a committee. Number two, when you're on it, use this report and dive down and use this as a way to have a conversation. From that last bullet point about the importance of sectors, and we're going into a panel now of companies and professionals from different sectors, and hopefully can get a little bit more explanation. So thank you very much.